Hey guys, Mark Fisher here. Just wanted to reach out, create this quick video. I hope everyone is safe and healthy during this crazy time we're experiencing right now. It's funny how there's things that we took for granted before that we didn't realize, like simply, just going to the office, which we can't really do right now. I miss my coworkers and being able to be in my office space, and now I'm working from home, which isn't as bad. I have my dogs here. I have my girlfriend here. I go from the living room to the kitchen to the backyard, try to get a change of scenery. But we definitely take things for granted, like just going to the coffee shop and being able to get some work done there. We can't do anymore. So I hope everyone is healthy and doing well. Wanted to make this quick video to share with you some of the things that I've seen in the marketplace, so that you could share with your clients, provide them with value and whatnot, and so that we could all come out of this on the right side once this is all finished. So one main thing I want to go over, I made a video on this before, and that is discussing the free mortgage payments or the forbearance that you've seen on the news. The news has done a really bad job of portraying what this really means. There is no free money. There's no free mortgage payment. You're not off the hook. A forbearance is simply your payments are on hold until a certain period of time. So what's typically happening is there's two scenarios two situations that are being offered to homeowners right now. The first one is that the 3 months worth of mortgage payments will be put on hold and they'll be added to the back end of the mortgage. That's the best case scenario. Another very common option, which is going to put people in a bad position, is that those 3 months worth of payments are due immediately in full upon the 4th month. So a lot of people don't realize this, and that's going to put people in a very, very bad spot once we come out of this. If you have to, make a $3,000 mortgage payment and you put that on hold, now you owe $9,000 at once upon the end of the 3rd month. That's a really bad position to be in if you weren't prepared for that. So it's definitely important to contact your loan servicer, find out if you qualify, find out what the terms of that forbearance would be before you make any decisions if you were going forward with the forbearance or not. A lot of renters are also seeing this on the news, thinking that their landlords don't have to make mortgage payments, so they don't have to make rent payments. But like I said, this is not the case. Everyone still has to, make the payments. This is a tough time. So if you're in that tough spot, then you should do the forbearance. But if you can make the payments, I recommend doing so, because otherwise this is going to put you in a worse position. Your escrows are going to get messed up. You're going to have an escrow shortage because you weren't making payments to build up your escrow account, and that's going to be short once you start making the payments again. And then they're going to have to increase your payments for the next few months to recover that loss. So definitely contact your loan servicer and find out what the details are before making any decisions on that. First and foremost, closings are still happening right now. At first, when we first heard that things were shut down, there was some uncertainty of how this was going to play out, if we could or could not close transactions, but closings are fully happening right now. Some of them are being done virtually, especially refinance transactions, which I've been doing a lot of right now. But purchase transactions, they either being done at the bank attorney's office right now in separate rooms to keep people safe, or they're being done at separate attorney's offices and whatnot, but closings are still happening. Appraisals are now being done as a desktop appraisal, so the appraiser doesn't have to physically go to the property right now. They're able to do everything from the computer based on public information that's available. So that's definitely helping to facilitate transactions from going forward instead of being held up because we can't get access to the property. There are some other things to be aware of. Employment verifications are very, very important right now since things are moving at such a fast pace. One day someone could be working, the next day they could be laid off or furloughed. So as you know, employment is mandatory in order to get a home loan. So we're doing day of closing verifications, which is typically done anyway, but these are even more stringent right now just to make sure that the parties involved can make the mortgage payments once they close on the transaction. We want to put people in the best position for success. We don't want to set them up for failure. So obviously having their income is a crucial part of being able to make those payments. The second thing is for self-employed borrowers, there are other steps that are being put in place by Fannie Mae and Freddie Mac for us to verify that the business is still operational. One of those things is to provide a business bank statement showing deposits into the account, showing the business is still receiving income. Typically speaking, when you have a self-employed borrower, you're going based on the net income of the last 2 years' tax returns. But right now, that's not a full guarantee that the business is still open, right? Because that's verifying last year's information. So we have to go a few steps further just to make sure that the business is still open and receiving income and still a viable business. And third, overtime and commission income is being scrutinized more right now because sometimes borrower's income for overtime and commission is being decreased or it's non-existent. And if that income is being used to qualify the transaction, that's something definitely that has to be looked at. Some other changes that I'm seeing take place in the market. FHA loans, we're seeing most investors increase the credit score requirements. So FHA hasn't necessarily changed their guidelines for the program, but pretty much 99% of investors I've seen out there have increased their credit score criteria just because these loans are much higher risk. They're typically lower credit scores, higher debt to income ratios, lower down payments, and overall a higher credit risk. So these organizations need to protect themselves and the integrity of the organization in general. If they have too many people that default, it can put them out of business. So FHA loans in general, the credit scores have been increased to 660 across the board. Typically before this, it was 580, or lenders would be a little bit more conservative at 620. But pretty much most people I've seen right now have been about 660. Also, non-QM loans, which have been pretty popular over the past year or two. Those are the bank statement loans. Those are the interest-only loans, the alternate verification type of loans, no income verification type of loans. That market is almost completely dried up at this point. The people that are still doing those loans, they're definitely being much more conservative. They're charging a much higher rate for those type of products, and they want a much higher down payment. Maximum from what I've seen is a 35% down payment requirement or 65% LTV, although some lenders are even more conservative than that. Also, jumbo loans, that market has definitely contracted a bit. Jumbo loans is a single family property that's over a 765 loan amount. That market has definitely got tighter. Either lenders have completely pulled out of that market, or they want more reserves, lower debt to income ratios, and things like that to preserve the integrity of that portfolio. Also, hard money loans. I spoke to a good friend of mine, Matthew Barbasia, who's a hard money lender. He's still funding, and a lot of other companies are still doing fundings, but they're also more conservative. They're looking mainly for liquidity of the borrower. So they're concerned with the loan to values and down payments and whatnot as well, but they're more concerned with liquidity. They want to make sure that the borrower has money left over. So if they do get into a position of not being able to make as much income and whatnot, that they can still make those monthly payments. So liquidity is very, very important. I think that buyers in this market who have an essential job or have a business that's still operational and whatnot and are looking to buy a property are going to have a good advantage at this point in time because there is less competition. So if you're working with a borrower like that, it's definitely going to be to their benefit. They could probably, find a house easier once, you're able to show these properties and definitely get better terms and things like that. For the sake of the borrower, I definitely recommend the borrower having reserves, which is money in the bank left over, a few months worth of payments, just to be safe. Even though that certain bank requirements may not require this, it's just common sense. If their job was affected, that you're not stuck against the wall and having to rely on a government program or whatnot to try and bail you out, which may or may not be available. I think the realtors should definitely verify that pre-approvals for clients they're working with are still valid because every lender is implementing different guideline changes and overlays and things like that. So you don't want to be finding out at the last minute after you've shown a dozen properties and negotiated an offer and whatnot that it's no longer valid anymore, or it's decreased, or certain things have changed. So definitely contact the lender to verify that. And also, certain lenders might be more conservative, so it might be a good idea to get a second opinion to make sure that it's definitely not viable, and making sure you're representing the client in their best interest. It's super, super important right now for a loan officer to be knowledgeable with guidelines and staying up to date with all of the guideline changes that are taking place right now. They're very rapid at this point in time because of everything that's going on in the marketplace, and investors just becoming, positioning themselves the right way so that they have less risk exposure. Online lenders aren't the way to go, especially right now, because they're not doing the right due diligence and they're not fully up to date with the guideline changes. Typically, they're not as experienced with these type of things. So I definitely recommend working with a loan officer who's knowledgeable and can, save you and your clients the time and stress of finding a property and then being let down because there's a surprise later on. Going back to what I said before with some great opportunities out there, I think that those clients who are essential workers or have those businesses that are thriving right now, they're going to be in a really good position coming out of this. I think that sellers' concessions will become more prevalent, which will help those people who didn't have as much in terms of funds to cover a full down payment and closing costs, or that just wanted to hold on to more money. I think we're going to see that as becoming a more viable option. I think that there's a better opportunity to get a better price, a better deal on properties coming out of this, at least initially, until people really get back into the market. And you just have less competition. So whereas you had a hard time getting an offer before, if you're putting 3.5% down or 5% down, now you have less competition, less people putting 20% down. So you have a better opportunity to win the house and get your offer accepted in the first place. In terms of rates are very, very low. Rates are very good right now. But credit has become even more important right now. So people with lower credit scores are being more affected. They're going to see higher rates than they would have before because these lenders don't want to take the extra risk with these lower FICO score borrowers because they're technically more inclined to not make payments and whatnot. So definitely working on your credit is going to help you in the long run and get you the lowest rate possible. I'm seeing rates that I've locked on a 15-year as low as 2.5, 2.625%, on a 30-year as low as 3%. But it really depends on your scenario. If you're buying a one-family versus a multifamily, what loan product you're doing, how much of a down payment, what your credit scores are, that's all going to impact what the rate would be. But generally speaking, rates are very, very low right now. So that's a huge advantage for people who are in the market to either buy or refinance right now. I've done a lot of refinances in the past month or so, and I think that's a good opportunity for people to save some money. So if you have any questions regarding if refinancing could benefit you or if it makes sense for you, feel free to reach out to me. If you're a realtor, I think that although you may be limited in what you could do, I know you can't physically go out and show properties, it might have to be virtual or whatnot, but there's still things you could do to put yourself in the right position coming out of this. I think that connecting with your database is super important, providing them with value, not necessarily soliciting them for business to buy or sell a property, but just be there for them, provide them with information, especially on the things with the forbearance and the mortgage payment situation. I think that it's a great time to implement systems into your business. Things that you didn't have time to do before, now there's a lot more time to do those things, whether you're looking to, implement a CRM into your business or, implement different other systems. You could help to grow your business and run smoother and more efficiently. Now is a perfect time to do that. I think that creating videos, if you were looking to do that and start that and you were holding off on it, now is a good time to do that. And I think that connecting with your database on social media is also very important. So if you have a past client database, I recommend taking those clients and adding them on social media platforms just so you could stay top of mind with them, provide them with value, and they're going to think about you when the time comes when they're looking to buy, sell, or whatever they're looking to do. And they could also refer you to their family and friends. But definitely provide value and don't necessarily solicit business, but be there and provide them with good information right now. And if you guys have any questions, if you need anything, I'm here for you. We're all in this together. I look forward to doing business with you and seeing you and reconnecting once this is all done. And I hope you're happy, healthy, and doing well.